Good morning, happy Friday, and welcome to another live video with Real Estate Mindset. I have Mitch here as a co-host. Happy Friday to you guys. We're going to do a complete and thorough overview of both the market, just the market in total, like the economy, the stock market. We'll go over all that type of stuff. But also, you guys, I'm sorry I can't talk right now. It's been a difficult transition back. But we're also going to go over a very detailed housing market update. And I'm going to show you guys towards the middle of this video, and I'll have everything chaptered, how to use the subdivision analysis form that I made for you guys. And that's something I'll be teaching here probably in the next month. I'll be teaching you guys how to use that subdivision analysis form, and I'll be teaching you guys how to fight property taxes. We are putting together a school. We are excited about that. So Mitch and I, and hopefully Melody Wright, will be doing seminars, possibly newsletters, and just overall starting a education course and curriculum. So we're really excited about that. Mitch Vexler, before we dig into this video, good morning. How are you? It's what, 7:15 a.m. It's pretty early. How you doing, buddy?
Yeah, it's all good. The market is doing what it's doing. Gold hit an all-time high yesterday, which is really interesting. Silver closed up 3.5%, and the NASDAQ is climbing its way back up from the shock of the deep seek, and it's all good.
This market is crazy, Mitch. I don't like it. I don't like it one bit, but it is what it is. It's important to hedge ourselves and adapt and figure out what's going on. Wanted to say good morning real quick. I am blessed from the very beginning. I really appreciated you. It's always nice to hear from you. Good morning. Roberto, good morning. Vovo, always nice to see you, brother. I've been seeing Vovo for about 2 years. Thank you for sticking around. Les Hom, it's been a long time since I've seen you. Good morning to you. Teresa, good morning. Greg, good morning. Good morning. Will rates ever go down? Yeah, they'll go down. When? It depends when we go into recession and when things start to collapse, I would say. Good morning. Good morning. We appreciate all you guys. So what we're going to do is we're going to start you guys off, and I'm going to do my first timestamp here at 2:10 mark. We're going to start off by, and I'm sorry to have to do this to you guys, but it is what it is. It's a long time since we've been doing a live. We're going to listen to the FOMC meeting, and we're going to listen to the introduction statement for Jerome Powell. And I'm going to tell you guys right now, it's mostly what he's saying is useless, but it's important for you guys to understand what this man is saying, who is the chairman of the Federal Reserve. They're absolutely murdering us. And I want you guys to listen to this and tell me what you guys think. And again, in the comment section below, give us your questions. So as we go through each segment, we'll answer your questions as well. Sorry for misspeaking. My God, it's early. I'm so worn out right now. All right, let's start this video right now. If you guys can't, let me know that the audio is good.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong, is strong overall, and has made significant progress toward our goals over the past 2 years. Labor market conditions have cooled from their formerly overheated state and remain solid. Inflation has moved much closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. For 2024 as a whole, GDP looks to have risen above 2%, bolstered by resilient consumer spending. Investment in equipment and intangibles appears to have slowed in the fourth quarter, but was strong for the year overall. Following weakness in the middle of last year, activity in the housing sector seems to have stabilized. In the labor market, conditions remain solid. Payroll job gains averaged 170,000 per month over the past 3 months. Following earlier increases, the unemployment rate has stabilized since the middle of last year, and at 4.1% in December remains low. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.6% over the 12 months ending in December, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. Over the course of our 3 previous meetings, we lowered our policy rate by a full percentage point from its peak. That recalibration of our policy stance was appropriate in light of the progress on inflation and the rebalancing in the labor market. With our policy stance significantly less restrictive than it had been and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. As we previously announced, our 5-year review of our monetary policy framework is taking place this year. At this meeting, the committee began its discussions by reviewing the context and outcomes of our previous review that concluded in 2020, as well as the experiences of other central banks in conducting reviews. Our review will again include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we'll be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer.
All right, that's going to do it. There's a little bit more there, but let's move on. And couple things, I want to respond to this comment here, but a couple things that hit me, Mitch. First of all, he said inflation expectations are well anchored. I'm about to show you and the viewers that inflation expectations have actually appear to be unanchored. One hand, he says he's not in a hurry, Mitch, but he just started cutting interest rates. He cut the first round of interest rates by 50 basis points. That screamed there's a problem. So he's on one hand saying he's not in a hurry. The other hand, this whole rate cut campaign. Is anything he said important, Mitch? I mean, it's literally, what is his purpose? Jerome Powell is just lying to us. Can you just explain if anything he's saying matters to us as a mom and pop? And then also, what do you think of this comment? I wonder if this is funny. I wonder if soft landing means gaslight the people until things start looking up. That's a funny comment. Happy Friday. That was a good one. What do you think, Mitch?
I read all the comments, and all the comments are right. So people are getting it. They understand that everything that he's saying is a straight up lie. His job is to promote a narrative, and the narrative is for the benefit of the banks, not for the benefit of mom and pop. When you look at all those people in that audience that he's talking to in that room, they probably have a salary well over $120,000. So for them to pay a $7,000 real estate check, oh, okay, I can afford it. You idiots are missing the entire problem. All your data is missing the entire problem. The only thing that separates 30% plus of the public from going bankrupt is $9,000. And of that $9,000, $7,000 is real estate tax. Over and above that, as far as Powell himself is concerned, you have to look at it this way. Every time he opens his mouth, it's a 50-50 crapshoot. Okay? There is no edge in having Jerome Powell or having the existence of the Federal Reserve, but for protecting the banks. There is no edge there. In other words, if he shows up in 30 days from now, does another press conference, well, this for the next 60 days, we're going to increase 25 basis points. It's a 50-50 crapshoot. Everything they're doing is completely irrelevant. They've only got one number that they need. The one number is the median household income against the operating expenses of the household. That's it. All this other analysis is complete kabuki theater. It's garbage. The entire Federal Reserve should be shut down. It's 23,000 employees. I'm sorry you're going to lose your job. That's not my problem. You've got a job that's totally dependent on stealing money and creating inflation against the citizens of the United States. Bye. It's real simple.
They're fired, Mitch. Hopefully
Yes.
they'll be fired.
If I was in the current administration, you got
You would fire them. I want you to run for office, Mitch. I would like to see what you do on day one. I have a comment here from Austin. Austin, we really appreciate your support. Thank you. Great comment here. And we'll give you guys an update on this. But this is what Austin's saying. Again, thank you for the support, brother. You guys have done a great job identifying and pursuing remedies for the fraud, which is one of them is conquering the apathy, which what I mean to say is as a viewer, you guys need to understand the fraud is going on. So first and foremost, understand the fraud is going on. So what he's saying, Mitch, and this is interesting, and I like this, you need to be more aggressive about increasing the velocity of the transmission of your findings. And they're suggesting, Austin's suggesting we contact Dr. Phil, Ben Shapiro, Pierce Morgan, etc. Now, we actually were just talking about this yesterday. Mitch, can you give the viewers an update on the bill that is circulating the House and Senate of Texas to repeal property taxes? And can you just let them know what's going on there? And also, Austin, we are making another video. I believe it's going to be tomorrow, Mitch, on the eliminating property taxes. And it seems like we're going to be able to interview a representative of the House of Texas that is supporting the bill. So we're making a lot of progress. It's still an uphill battle. But Mitch, can you give them an update on the property tax bill and eliminating property taxes?
Sure. With regard to contacting people like Dr. Phil or Ben Shapiro, ideally, yes. But the way the system apparently works is you have to know somebody. And one of the issues with me personally, I'm not on social media. I'm not on X. I'm not on Facebook. I do this with Travis because it gives us the ability to go back and forth and have a conversation. The other videos that I did with the other interviewers, again, they're from the real estate world, so they can ask me questions that I can open up and help everybody understand what's going on. It really doesn't work if they're not from the real estate world. So Dr. Phil would be great. Ben Shapiro would be great because he would have the ability to use his attorney theories on how to conduct a deposition with me, and we would make very interesting video. But the reality is, I did reach out to Dr. Phil, never heard back, but I don't even know that they got it. See, that's part of the problem. They have handlers, and it's just an issue. So, and what was your other issue with regard to the bill? Okay. So the bill is and has been placed in the hands of a Texas state representative. I received a phone call 2 days ago that they've moved that bill into the hands of the attorneys to literally turn it into a formal bill. So it's a proposal, then it goes to the attorneys, and the attorneys double check the dates, and they send it back to me and say, is everything okay? And if it's okay, then it gets turned into a bill, and then it goes and to be circulated throughout the House Ways and Means Committee, and then to the Texas Senate for approval. You have to realize it's hard hitting. The last two videos that we did are building a box, a framework around those politicians. So that's really what we're doing. The third video with one of the Texas reps that ideally will get done tomorrow that completes the box, but it puts every politician, including Governor Abbott, in a box such that if you vote against this bill, you are literally voting against your constituents, your citizens throughout the state of Texas. And I mean all citizens. And you would be voting against your friends, and you would be voting against your family. And part of what we're producing in this upcoming video is a list of every single one of them. Email, addresses. I'm going to create a form, and in that form, it'll say as a letter, it's a form letter to be sent by everybody that gets it to Governor Abbott's office. And that will start to build the pressure so that they see it in the mail. Plus, obviously, these last two videos, just so you understand, I did send those videos. Every time we do that type of video where I produce an email, I send that email not only to the FBI and the district attorneys, I also send it to Governor Abbott's office. I send it to Ken Paxton directly. I send it to Glenn Hagar directly. They all know beyond a shadow of a doubt what we're doing here. And not one of them has bothered to pick up the phone and say, yeah, we agree, we disagree. Now, they're going to say, well, it's such a big problem, we don't know what to do with it. Well, it's real simple. Shut it down. We've given you the math. We've given you the evidence. How much more evidence do you need? I've got it on tape. Oh, well, we took 60,000 properties outside of the database, manipulated them in Excel, and put it back. You understand? That's criminal. Straight up, I've got you. So there's no debating the evidence. It's irrefutable. The only question is, are you, the politicians, hearing what's happening? 30% plus of your population, your household population, is dancing on bankruptcy. The only thing that's stopping them from going bankrupt is $9,000. And of that $9,000, $7,000 is real estate tax. And by the way, if you idiots think, well, it's no big deal. Really? If those 30% plus stop paying the real estate tax, and then they take the attitude, well, it's going to roll up to the next level of 30% plus. They don't have the money either. You've got the rule of 72 working against every single one of these politicians. Therefore, wake the hell up and let's get busy and fix this. Because if you don't, you will end up in a greater depression. It'll make the original depression look like a piker. You'll see the destruction of the US dollar. These things are real. This math is real. I've got friends at MIT that have gone over this with me. There's no doubt that the math is the math. So that's what's happening.
All right, Austin, we thank you for, again, the support. Hopefully that was a good update, but we'll have more videos and we'll show you guys where we're at with that. I mean, that's a big deal. We really try. I mean, we're not messing around with this property tax stuff, guys. We're doing a lot of stuff behind the scenes that a lot of people don't know about. It's hard. Real quick. Good morning, Jeff. It's nice to see you. Jeff is a watch. He's been watching the channel from the very beginning. I love Jeff. I consider him a friend. Sean and Wendy, it's nice to see you. Les, yes, it does. Yes, it does. Good morning, TK. So yes, obviously we're reaching out to a lot of people. But let's go into the market update real quick, and I'll try to make some time again on the next segment to respond to some of the questions, some really good questions. But let's go into our market update, starting with the 10-year Treasury. Now, we've been watching the 10-year Treasury, obviously, you guys, because the 10-year Treasury really impacts residential mortgage rates. Right now, we're sitting at 4.5 right now. It's up about 2 basis points. Now, this has been sideways for about 45 days, so not a lot has been happening here. And understand the rates have been being cut. The federal funds rate has been cut. This has been going up. So it's got a mind of its own. My point is the Fed doesn't have full control over the 10-year, although they are manipulating it like crazy. Either way, it's going to affect mortgage rates. Mortgage rates have been about 7% for the last 45 days. So it's basically stuck. This 10-year, which again is very important to us, has been stuck at about 4.5%. So keep your eyes on that, you guys. Here's gold. We have a couple comments on gold. Not quite a new high, but I think what was the record? It went up to about 29, almost 29, Mitch, but we got near record high gold. We're going to listen to a video here in a second about how central bankers are purchasing gold. And I'll ask Mitch whether or not he thinks that there's more room to buy gold and it's not too bubbly. But either way, that sucker is up there. Look at that, guys. Per ounce, $2,845. That's pretty crazy, actually. Moving on, looking at the futures right here, and you guys can kind of see us in the upper left. Futures are slightly up, about half point up. Dow, S&P, NASDAQ. I mean, literally everything's up. Crude's up. Probably the only thing that's not up is the VIX. but still things are still pretty bubbly. Now, take a look at this, guys. This is the 5-year break-even inflation rate. Now, I've shown this chart based on a year. So this is the 1-year chart of the 5-year break-even inflation rate. So this is the market's expectation of inflation 5 years from now. And remember, Jerome Powell said that the expectations of inflation have been anchored. What I wanted to show you guys is they haven't really been anchored at all. If you look at the 1-year chart, it's actually up year over year. So in the last year of Jerome Powell doing quantitative tightening, elevated interest rates, the expectations for inflation have gotten worse, not better. That is not anchored. That is in the wrong direction over the year. You can see that right here from this point where my mouse is at all the way to here. Expectations have been going up. And if you really want to look at it from September on. It went from 1.86. We're finally starting to get proper expectations. And then boom, skyrockets up. That was from elections. So as soon as elections, we're starting, this sucker started going back up. But either way, you guys, looking at this, it doesn't look like inflation is going anywhere. Another reason why Jerome Powell is completely useless to us as Americans and mom and pops. Here's the market's expectation of what's going to happen next with interest rates from the Federal Reserve. Very interesting stuff. The market keeps changing this. Obviously, CME Fed Watch is almost useless, but it's interesting to see what is the expectations of the market. They're saying in March that they're not going to cut rates. So 82% chance that rates will hold in March. And take a look at May. May, same thing, over 58.6%. So the market's not really pricing in rate cuts until June. So it goes under 50% likelihood or probability or expectation, whatever you want to say, in June. Very interesting. So next rate cut, according to the market, June of this year. Very interesting. Now, take a look at this. Now, here, I want to remind you guys, because people keep getting this wrong. The Fed doesn't cut rates when the economy is doing good. The Fed cuts rates when the economy is doing bad. The Fed can increase rates. They go up when the economy is doing good. These are just like the simple little things that most people need to understand. Once you understand that concept, we can talk. But still, Mitch, there's still so many people, they don't get it. Imagine all the homeowners that purchased a house expecting to refinance into a lower rate. Or imagine the people that purchased a house in 2021, 2022 that weren't prepared for the massive skyrocketing property taxes, homeowners insurance. If you purchased a home in the last 3 to 4 years and you didn't purchase with like intellect and understand what's going on, all you guys got blindsided and bamboozled. If it wasn't property taxes or homeowners insurance, it was the fact that you thought you can buy and then refinance later. You can't refinance later. I mean, the rates are still 7%. But my point is, when the Fed starts cutting interest rates, they cut interest rates right into recession. Remember that. Here's the trajectory. Look at this. The trajectory, anyone could tell, my children can't, is going down. Okay, so the federal funds rate's being cut. Look at the previous recession. Interest rates were going up. They started cutting interest rates right into recession. Same thing with the global financial crisis. Look at interest rates are going up. They plateau and they start cutting interest rates right into recession. Look at global financial crisis. .com bubble, same thing. Interest rates going up. They go sideways and then they cut the interest rates right into recession. The recession is due, and hopefully it won't turn into a depression. You guys, we have all the signs that a recession is coming and paying for mom and pop with it. Layoffs, things of that nature. It's going to be hard to get loans. So that's why I've been telling you guys for the last 2.5 years, maintain your credit, don't get in debt and things like that. But look at that. This is proof positive. When rates go down like this, we go into recession. So what do you guys think is going to happen? Anyways, the other crazy thing, though, is even with that, having said that, we also are battling inflation at the same time. And inflation is ever plentiful in the market. You can see that in the overnight reverse repo. It's still sitting at 125 billion. So this is kind of, there's too much money for the banks. Why do people still, not all people, Mitch, but still some people like, oh no, we need the Federal Reserve. Why do we need the Federal Reserve? Explain to me why do we need the Federal Reserve? I don't think we need the Federal Reserve. I'm not a banker. I don't like bankers. I don't have any family in banking. I don't think people understand that the Federal Reserve is killing us. They're taxing us to save banks. So the Fed saves banks at our expense. Save bank, we pay that cost. Why do we need them? We have to start standing up for our rights. Regardless, 125 billion in the reverse repo market. Let's keep going here. Also, the Treasury General Account. I want you guys to remember, they still have 784 billion. So why are we passing more money? Why is FEMA broke? Why can't they help people in Tennessee and North Carolina? Look at $784 billion in the Treasury General account. Use that money to help the victims from the hurricane, for one thing. And if you look pre-pandemic, the Treasury General account was what, 200 to 300 billion? It's double that right now. So when did we have to start having so much money in this account? I mean, they are just, the inflation is so plentiful. It's like stuck. So I look at this as, Mitch, as like stuck inflation. Like they're trying to get this out of the system into the economy. Regardless, look at this. This is absolutely crazy as well. This is the Federal Reserve's mortgage-backed security holdings. They got $2.2 trillion. And I want you guys to pay attention to this. The Federal Reserve didn't start doing quantitative easing in the form of mortgage-backed securities until 2008. This is relatively new, and this is very, very bad. What this does is it allows basically a backstop to banks. So it allows banks not to fail. And to be honest with you guys, I'm going to say point blank, like what's different now versus last time? We need the banks to fail. If they keep propping the banks up, we're going to keep paying the cost. They need to let the banks fail. If a bank does risky business, bad business, they deserve to go out of business. As taxpayers, I don't want to save a failing bank. They're greedy and I don't like them. It is what it is. Still a lot of money here. And on top of the lot of money and inflation in the system, we got compounding problems here of just absolute debauchery and debt. This is the first quarter of the fiscal year of 2025. Remember, it starts October to October. We're sitting at $711 billion. That's 39% up. I believe this is the second worst quarter of deficit spending in history. In history, you guys. In other words, we have a lot of inflation, a lot of unaffordability, a lot of lying, a lot of problems. And it is unfortunate. Mitch, I'm going to tee up a video here, but any comments you want to make on that? And I will ask you this: will inflation ever go away? Will it ever go away? Are we stuck with this inflation?
Yeah, I want to take a step back. So the biggest Ponzi scheme in the world was the second to last video that we did, followed by the school district fraud. Those two videos are the ultimate summaries of what I've been doing since I started this entire series of videos. And they have been sent. And it would be good for everybody to send them to people like whoever you want, Ben Shapiro, et cetera, to push it. Those two videos will get somebody up to speed. This next video is a direct aim at the legislators. So all of these things, and the reason why I'm raising this issue, the Federal Reserve, along with the central appraisal districts, are the purveyors of fraud. If you get rid of the fraud, you get rid of the inflation. They're absolutely 100% correlated. So I would love the opportunity, which will never happen, but I would love that opportunity to very nicely and calmly have a conversation with Jerome Powell and point out that everything he said is a lie. And I would just want to go back to that. Well, we want to stabilize employment. We want max employment. Really? Okay. Failed. We want stable prices. Failed. Right? He just comes out of the chute and makes a statement. But the truth is, if you listen carefully and you look at what Travis just showed on those charts, it's clear you failed. Inflation, hot, failed. Therefore, as I said, what is the purpose of your existence? It is purely to protect the banks. Every time you have to write a check to save a bank, you are creating fraud. That's the reality of it. The ultimate purveyors of fraud is the Federal Reserve and the local central appraisal districts, which are owned by the school districts, the taxing entities. You want to get rid of the inflation? Get rid of the fraud.
Well said. So hopefully it will go away, and Doge and Elon Musk and all of the promises that they've made to, drain the swamp and fire the excess. Hopefully that will come to fruition. Got a couple things here. One's from Greg. I meant to talk about this earlier, but we went a little bit long in that last segment. Greg is asking, all interest rates should be set by the market, not some arbitrary group of very wealthy people. That's exactly right. And that's what the Federal Reserve is, guys. The Federal Reserve is bad for us. So I hope that's what you're understanding at the very minimum from what we're talking about. Let me throw up another comment here. So this is from Angela. Can Trump fire him? This is regarding Jerome Powell. Can't believe what he said. So there's, and I just want to get through this real quick. He can close down the Federal Reserve. He could literally fire everyone by closing down the Federal Reserve. Hold on one second, Mitch. I know you're chomping at the bit. I can sense it in my peripheral sensing. Here's from CB right here. I don't see how, and this one's for you, Mitch. I don't see how you say we're going into recession and inflation when food is 3 times higher under Biden administration, hundreds of billions of money to Ukraine, endless debt cards for illegals. That's a lot. And I want to point out real quick, and I want you to answer this, Mitch, that we went into recession in the 70s and 80s when they were fighting inflation. But can you go into how the inflation can actually make this situation worse, Mitch, and not better as far as going into recession, potentially depression because of the inflation?
First of all, one must understand that the definition of CPI, Consumer Price Index, has been modified multiple times over the last 15 years. They have stripped out food. The actual cost of food is not in the CPI. When you go back to the original definition of the Consumer Price Index, as I've said, we are in a recession. It is irrefutable. There's nothing here to debate. What is debatable is what they've done by manipulating the math under the hood to paint the narrative. And it all falls right back at the feet of the Federal Reserve. They manipulated the definition of Consumer Price Index. So the comment that, yes, food is 3 times higher, it's actually higher than that. So it depends what you're looking at, right? If you go and look at eggs, it's up 300%. So bread, like a loaf of bread now, just a white loaf, nothing fancy, $7. So when you start understanding so 4 years ago it was about $1.50. So when you understand what's going on, it's cumulative compounding of the fraud that's ending up in every level. So when your central appraisal district jacks the real estate prices up 100%, it has nothing to do with the original value. The value is the value. The tax is what they're jacking up based on the fraud. So inside your glass of milk and your cappuccino are 8 elements of real estate tax. Every single one of those entities in that real estate tax, right down to the farm, because we showed that in the graph on the school district fraud with the farmers and that one piece of chart, that the farmland was up 249%. Well, that element gets passed on in your glass of milk or in your wheat that is in your toast. It's all there. So it's cumulative compounding of fraud. The only way to fix this is eliminate the fraud. So when people say, and Travis was saying, based on the CPI, based on what the narrative is, what the truth is, we've been for at least 1 3/4 years in a recession. And the proof is Powell's own statements. Well, max employment. No, we don't have that. Max or job or price stability. Well, we don't have that. Well, if we don't have these elements and you took those elements out of the definition of CPI and you put those elements back in, I'm sorry, Jerome Powell, you are a purveyor of fraud. You, sir, are a fraudster. You have a job that pays you well, literally to commit fraud on the public of the United States of America and the rest of the world. This guy, the entirety Federal Reserve, is jacking around not only the United States, but Canada, because the Canadians can't think straight. So they copy what the Federal Reserve does. Well, you got the same problem with the IMF, the International Monetary Fund. You got the same problem with the European Union. You shut the Federal Reserve down, and all of a sudden, the globe will start coming down and eliminating the fraud throughout everything. There's no reason for the tariffs. The tariffs are a necessity because Trump's got to fix the cash flow coming in because of the amount of money that the Federal Reserve has jacked the rest of the world around with. Get rid of the fraud, and the inflation will disappear.
Mitch, I got something for you here, and then we're going to go into the video, but I thought this was good because it's hitting new highs. Okay. Okay. Let me tee this up though. Okay. So the question is, should I sell my gold? Our next video is how central banks are purchasing gold right now. We just had a record high. My gosh, do I have time to buy gold? Mitch, or is it high right now? Too high? Should I sell my gold? Maybe buy silver? You're not a financial advisor, but you know a little bit about some metals and stuff. What do you think about selling gold right now? Should we hold? Should we sell? What do you think?
Well, you're right. We're not financial advisors. With that said, financial advisors aren't financial advisors either because not very smart. So here's the reality. Gold and silver, be it precious metals and platinum, are currency. It's money. Okay. It's a store of value. So this is about 6 weeks ago, silver took a nosedive, and it was a big nosedive. It was over 10%. If those people panicked and they panicked out, silver's already gained back just in the last 2 days, half of that 10% move. So silver probably within another 3 weeks is going to be right back to its all-time high. So these things are happening because if you stand back and you look at a guy like me who used to make his money in real estate, right? I still will. I'm a developer, but I just can't build because I can't go to my investors and say, yeah, I'm going to be held up for extortion on real estate tax. And yeah, I can't guarantee a rate of return, but give me the money. Let's go and do a $50 million project and say la vie. I can't do it. I won't do it. So I look for other assets to buy in real estate. But the point is, I have a margin of safety in that real estate. That's why I've got a long, successful track record. I build a margin of safety into these deals. Through the Federal Reserve and through the CADs, they've taken that margin of safety away. Well, where would a guy like me go but for precious metals? Because if you can't get a rate of return, that tells you that the system is broken. Well, why are the central banks themselves buying up all the metal? Why is China literally has locked down their own creation of gold? They're saying, you can create it. We, the government, are taking it. We're going to buy it from you. They're doing that because the precious metals are currency. So it's a currency, it's money, and it's a store of value. They know that even the Chinese government knows that the system is broken. The narrative hasn't hit the street. So the idea of saying, well, I've got some gold or I've got some silver and I want to sell it, my personal, if you're asking me what I would do, no, I would not sell it. If somebody needs the money, that's a different story. But it doesn't make sense to sell because where else are you going to go?
Yeah.
Are you going to go buy multifamily where your tenants can't afford to pay your rent? Are you going to go buy warehousing, mini warehousing, which right now, on average, has got 20% vacancy? Well, that doesn't make a hell of a lot of sense because it's overbuilt. Are you going to go buy RV parks? They're overbuilt. There's too many of them. So are you going to go put the money in the stock market? Are you a trader? If you're not a trader and you think you're going to rely on a financial consultant to tell you what stocks to buy, you're crazy, right? All you got to do with a consultant is say, show me your rate of return. Give me your equity curve. And if they can't do it, then you're wasting your time even talking to them. So you see, there just aren't that many places to hide. At least the gold and the silver is in your hand or in the ground, wherever you put it.
Mitch, I may go buy some silver after this, to be honest with you. I'm already thinking like, can I use this money? I'm going to buy some silver, buddy. I may buy some silver. I don't know yet. Let's move now. And, you actually segue really perfect into this next video. I'm going to do our timestamp real quick. This is going to be on the central banks purchasing gold and rare minerals and things like that. And China, let me know that the video audio is okay, you guys. I'm going to put us on mute so there's no echo right now, Mitch, and we'll get started.
About 3 other commodities, gold, copper, and soybean. Let's start with gold. China actually restarted its purchases of gold for its central bank in December, obviously right after the election. That's been a boost to gold prices. What are the other factors that could be an influence on gold prices, specifically those Trump tariff policies and trade policies?
So the tariff policies have really caused central banks to continue to purchase gold. We're seeing many central banks out there boosting those reserves. And what it's doing is it's helping alleviate some of the pressure because you look at a lot of the foreign currencies, they've declined specifically against the US dollar. Now, the high tariff, the high inflation possibly from tariffs could really throw a wrench in the global economy and specifically the US economy. At the same time, if he does a mass deportation, you could see the labor market becomes slightly strained. And what happens is growth in the United States will start to stall out. So what a lot of traders are positioning for is more of a stagflationary environment down the road in the U.S. You lose the unskilled, labor worker. You're going to have to raise wages, and then that's how that environment is created.
All right. So again, year to date, gold's up just over 5%. Now, copper's a bit of a different story. Copper's gotten a big boost this year from strong export-import numbers out of China. Copper moving up almost 9% year to date. What are the Trump trade policies? Tariff seems like the obvious answer, but what are the Trump trade policies and tariff policies that could impact this trade?
So he really dialed back his threats to China here, specifically in the last 24 hours. And copper remains one of our favorite commodities in the metals complex, and it often acts as a leading indicator for inflation and also the economy. So you go look at global demand for copper, expected to double over the next decade. Everything from EV vehicles. Remember, an EV vehicle uses 4 times more copper than your traditional gas vehicle. You also have AI, which the increase in the intensity of computing really is going to cause that demand to go up. You're going to need better computers, new technology, also the grid renewable technologies. The tailwind is China's demand is really shifting from that property sector to manufacturing and technology. And then we also expect that constant traditional demand to pick up in 2025, construction, infrastructure spending, and also defense.
All right. So again, copper up just about 9% year to date. Now, soybeans is a bit of a different story. Especially when it comes to American soybean farmers. They really rely on that export market to China. China is one of the biggest importers of soybeans. During the first Trump administration, during the trade war, a lot of impact to the soybean market because China stopped importing so many soybeans. What's the outlook here when it comes to soybeans? Why are soybeans up nearly 11% year to date?
It's pretty incredible. I mean, much of it multi-month highs. It's been the unfavorable weather conditions down in South America that's reduced the global supplies. But in 2024, China had imported a record amount of soybeans. 71% of the market share is for Brazil, about 21% to the U.S. If we do implement this hard stance, these tariffs on China, you're going to see the U.S. lose some of that market share. So, but it's really him dialing it back is where we've seen China, they've already secured quite a bit of soybeans ahead of him coming into office. Now, today, we probably have a small shift in the weather. That's why beans are down just a little bit. But it's been a great opportunity to farmers to hedge going forward their crop, especially with corn knocking on the door of $5 and then beans back at about 10.5.
Okie dokie. Now I have a question for you, Mitch. Got some good comments up there. You guys keep throwing up your comments. I really appreciate you guys' engagement and your opinions and thoughts. Now I'm about to go into the housing market update. This is going to be a very thorough update because I'm going to show you guys how to find a great deal, or at least the basic math and finding wedge and cash flow. So I'm going to go over that. But before I go into the housing market update, Mitch, why do you think, and you kind of alluded to this a little earlier, but why do you think that central banks are purchasing so much gold right now?
Because the system is dancing on the cusp of collapsing. And I'm talking about the currency system. So it's not that the world is going to self-implode. What happens is the currency implodes. And they're looking at it and saying, well, we've created such a mess with the debt. We have to come up with something that will reprice the US dollar. So Russia and China have gotten together and they've created something called the unit. Well, the unit is based on a unit of gold. And it's hard to get into the actual mathematics of it without boring everybody to death. But the bottom line is that they're going to, by using the unit, they're going to get the US government to do the heavy lifting with regard to the price of gold or the price of silver. And it'll take place probably over a 24-month period, but it's well underway. And that's why they're buying gold. That's why every country on the globe, every central banker is buying gold. And in fact, just yesterday, the LBMA, which is out of London, ran out of silver. So the huge quantities, there were 400 tons of gold that left the LBMA and were put here in the United States. So there's a lot of movement and things happening under the hood that we don't have privy of. So that goes to the point of, should I sell the gold? If you're asking me, would I do it? No, I would not sell gold. No, I would not sell silver. I was actually looking at buying a semi-load of copper just to have the copper for the same reason that copper has run. So the guy that you just had on that video, he was mostly right. But when he said, well, the labor, by getting rid of the illegal aliens, is going to cause a problem. No, because most of them didn't have a job. But I want to go past his statement because somebody mentioned Lennar Homes in the clip. Lennar Homes quality, D.R. Horton quality, Toll Brothers quality, and Toll is the top of the spectrum. The quality of the product has dropped, as has inflation run. So these things are all connected at the hip. They do have a labor problem. They can't get enough labor. The labor they have is not trained labor. The quality of the materials, like if you go to Home Depot, you'll see studs that are curved up 20 or 30%. It's garbage. You wouldn't want to put that in your house if you want to have a house that's going to last for a long time. So again, they're delivering product that, as compared to something that was delivered 15 years ago or 20 years ago, the truth is you're better off with an older home than you are a newer home. These newer homes have problems. So price is what you pay. Value is what you receive. In the middle of all this, pushing on both ends of this, which they actually call push and pull, so is the inflation. You have push inflation and pull inflation, push price and pull price. These entities, D.R. Horton is getting smacked in the middle, Lennar, anybody who's a builder, go and ask them, how's your labor? How's your plumber doing? They're going to say, horrible, I don't have enough labor. Okay, how are your supplies over at Home Depot or Lowe's doing? Horrible. So all of these things, where are your parts coming in from at Home Depot or Lowe's? China. What's your quality? Pathetic. It's all connected. It's all a result of the inflation. It's all a result of the fraud. Price is what you pay. Value is what you receive. And the precious metals are in your pocket.
Yes.
They're yours. Or in the ground, wherever you put them, right? But they're yours. It's not in the hands of a bank. Value is what you have.
In other words, guys, don't use your emotion to buy a house. Please just don't do that. It's never been a worse time or more dangerous to buy a house in the history of, well, maybe in 2022, it just depends. But there is a way to buy a house to have less risk than just going and buying a house. So we'll go over that here now. Mitch, I appreciate you. We're going to go into the housing market update. Let me do our first timestamp. This is going to be a good one because we're going to do a very thorough coverage of the housing market. And let me start by putting this on the screen right here. So we're going to start talking about demand. And again, I'll get to the a market analysis form, which I will be teaching in about a month. So I'll be doing seminars on that. That's how to use the math to find a great deal. But starting with the market, the housing market, and with demand specifically, here's mortgage applications. I took this back to 1991. The demand is shown in blue. The interest rate is that orange line that's going up and down. And really what I'm trying to point out here, guys, is demand is about 1990 levels. Okay, so demand right now for a mortgage or to buy a home is worse than the global financial crisis. That's right. The demand to buy a house right now is worse than the global financial crisis, which some would argue, including me, that that's one of the reasons why we haven't had price discovery. The other reason, institutional investors and inflation and things like that, and also supporting the banks and not letting them fail. So those are also reasons. But regardless, the demand is down massively. When we look at just refinances, same thing here. Refinances is probably the worst it's been almost ever for this period of time, for the length of time. So refinances in the absolute gutter. You look at the purchases also in the gutter. But my point earlier is we may not have price discovery until we have more inventory and more transactions, because the transactions are so low right now and loan modifications are so valuable, and the Fed is bailing out banks like they did in March of 2023. It's taking a long time. And it's unfortunate, but regardless, we don't have price discovery yet. Demand has absolutely crashed. Now, a little bit more of an update here. Here's Redfin's updated article. I'll go through this very quickly here. Let me zoom in here. The typical home is taking nearly 2 months to sell. That's the slowest pace in 5 years. So the housing market is changing. The optimism is not. It's still foolish optimism. It's still leading people off a ledge of financial suicide. There's a way to purchase homes. I know there's pride in purchasing. I know it's primary residence. I know there's emotion that goes into it. That's why I'm doing the channel and saying the things I'm doing and warning you guys. The business is designed to prey off of your emotion. So the more math you do, the better you're going to be. Now, here's what this says. There are more than 5 months of supply on the market. That's crazy. That's the most since early 2019. We have more supply than COVID, guys, than pre-COVID. That's crazy. Homes are taking a long time to sell, largely because housing costs are so expensive. But for buyers who can afford it, there are a fair amount of homes to choose from. So let's go down here to the over-optimistic realtor comment right here. And if you're a realtor and you're listening to this channel, props to you, because we need to do better. I'm also a realtor. We need to do a lot better. We need to stop the cheerleading, and we need to start showing people how to use the math to find the deal. That's what we can do to help earn our commission and to help society. Stop the cheerleading, for the love of God. This is what a realtor says. Prospective buyers have been cautious because they have seen homes sitting on the market. So they haven't been cautious because of the unaffordability and the overwhelming prices. Are you kidding me? Anyways, I'm sorry. And they've heard interest rates and prices may drop. They've been hearing interest rates are going to drop and prices have dropped for the last 2 or 3 years. When the market isn't competitive, it hasn't been competitive in what, 2 or 3 years? So, well, in most markets, some markets are still tight. Some buyers think that they should wait for costs to go down. Well, they should afford a house, right? It's one of the largest transactions of your life. Now it's pretty clear that sellers aren't slashing asking prices. Well, they are in some metro areas, and mortgage rates aren't plummeting. That's true. So mindsets are shifting, but not the realtor mindsets. It's still cheerleading. People are starting to believe that if they want or need to move, they can afford it. They can afford to, they should do it. But they don't talk about affordability. They never talk about it. They're just like, if you afford it, you know best. We're not going to explain what affordability means. We're not going to tell you how to hedge yourself. We're going to just leave that up to you and say, hey, based on your emotion, if you can afford a house, let's go buy one this weekend, because we got a lot more inventory, a lot more options. Anyways, just be very careful. Here's the leading indicators right here, you guys. Interest rates, as far as the daily average, are up from 6.95% year over year. So interest rates are higher year over year. Weekly average is up year over year. Mortgage purchase applications is down year over year, 7%. Home buying demand is down 1% year over year. Google Homes for searches is unchanged. It's essentially, guys, the law of supply and demand, it's all firing on all cylinders to drop prices naturally. Now, median sales price went up to 377, 125. Let me go down to visualize some of this in a minute. Let's talk about the winners and losers, starting with prices. So here's the winners and losers. So starting with median sales price, which there are many problems. This is not a true median sales price. This is a manipulated median sales price based on proprietary information from Redfin. They've also laced in here new home data. So in other words, it's not real. There are some metros that are doing good, some are doing bad, and within those metros, some subdivisions doing good and bad. And I'm going to teach you that skill here in a minute. But the top metro areas, number one, Pittsburgh, up year over year, 19.3%. That's crazy. Milwaukee, are you serious right now? So Milwaukee is at 16.7 right now. Fort Lauderdale up 14.2% year over year. Newark up 13.4. Cincinnati up 11.7. Losing metro areas, California metro leading the way now. Very interesting. San Francisco is the number one declining metro area year over year so far, down actually 5.6% year over year. Usual suspect in Austin, who has been down about 3 years straight. They're down again year over year, 2.6%. Tampa, number 3 at 1.5%. Now look at the new listings. This is the name of the game. We want more listings. Number one metro with growing listings is actually also in California, San Jose, California. Probably going to be some price decline in those overvalued metros. Phoenix is number 2. Thank goodness. Maybe it's the chip plant. I don't know, but Phoenix is up new listings. I'm sorry, at 19.5%. Seattle, number 3 at 15.2. Oakland, number 4 at 14.5. Sacramento at 14.2. So notice all pretty much West Coast. That's interesting. Now, the metro areas that are not getting new listings, a little bit concerning. Leading the way, San Antonio, that's not good. That's right down the way from me, down 17.4. Detroit, number 2, also not good, 16.6 down. Newark, down 14. Atlanta, down 12. And Warren, down 11.6%. Again, that's new listings coming to the market. Here's the median sales price. You guys see that we're elevated, kind of started the year going down, slight upward trajectory. We'll see how that plays out. Now, median asking price comes before sales price. that's absolutely skyrocketing. So the asking price is skyrocketing. To me, that shows that the growth is in the upper end of the median. Remember, the median is whatever's in the middle. So if the upper end of that median is flourishing, it's causing more transactions over $1 million. The median shifts upward. I don't know if that made sense to you, but either way, the higher price points, like people that have a lot of money, they're still doing transactions. And I believe that's reflected in that asking price medium. Here's what's the problem, you guys. Home buying, housing payments, that's up 8% year over year. Home buying mortgage payments are about $2,753. Remember, back in 2022, this time of year, they were under $1,750. So mortgage payments are over $1,000 higher. That's what you get if you're going to buy a house right now. It's very, very risky. You don't have to do it. Take your time. Pending sales down 9% actually year over year. New listings, you can see it going up. We want it to go up more, but it is up at least year over year, 2%. Active listings sitting at 889,000. We want this at 1 million, kind of going down a little bit. Hopefully that will start going up here in March. We'll keep an eye on that. Now, this is crazy. Supply's at 5.2 months. That is the most supply we've had in at least 4 years, probably more like 5 years. So we have an overwhelming amount of supply right now. This is according to data, right? So 5.2 months, that's a ton. When we get to 6 months, it's like all hell's breaking loose, right? In other words, just take your time, guys. Use the math. Let's see what else we got here. Here's the Redfin home buying demand. That's also down. Now, what I'm going to do is, let me go back to you, Mitch. I'm going to tee up real quick this form. Let me show the people. So I'm going to tee up this form, which is the subdivision analysis form. But before I do that, Mitch, any comments you want to make about what we just covered on the housing market?
Yeah, two things. With regard to the precious metals, don't everybody or anybody go out and say, okay, I got $10,000, I'm just going to go buy silver. Don't do that. So if you look at your portfolio, including your house value, or anything else that's got debt on, you say, look, I'm worth X and I want to have 3 to 5% of my worth in precious metals, and you scale in over time, that makes good sense. Don't do anything crazy. Now, with regard to what Travis was just showing in Redfin, all real estate is local. So there's such a thing, it's called the flaw of averages. When you see these reports and they make global statements, that's a flaw of average. There's a high probability they didn't look at every individual area and break it down. So to get to the truth in your neighborhood of where it is you want to buy, the only way to get to the real truth is get in the car and drive around to the subdivisions, pick a subdivision and do the analysis on it. How many for sale signs do you see? Stop and ask somebody who's living there, are there more people in this subdivision selling? I'm interested in buying. Just have a conversation. And the second you realize what comes out of that conversation is going to tell you the truth. Is this a good neighborhood? Is this dollar per square foot value? Am I going to get something for my money? So those are the issues. They're kind of connected at the hip, right? It's about getting value for your purchasing power.
Always great to hear from you and to hear your opinion, Mitch. Appreciate it. Now I'm going to go into this. Okay, this is, let me throw this up for the viewers again. Look at my screen, guys. This is a subdivision analysis form. This is a little bit more advanced training that I'm going to be doing. This is, again, how to use the math. We don't have to use our emotions to purchase real estate. If you are a realtor, this is what you do to really, really give value back to your client. So again, we're going to do a subdivision analysis form right now. Let me actually timestamp that real quick, Mitch, at 58. So the purpose of using this form, again, is to calculate wedge and cash flow. And really, this is the base, just the basic steps to do that. So this is just the first steps. After you would fill out this form, you would do additional research on the condition of the property, see how much repairs would cost and things like that. But the purpose of showing you this form is so that you guys can understand the math. And it's all about comps. And remember, you guys, a comp is a home that's sold. And when you do your analysis, you don't do it on the whole city. You do it individually on the neighborhood or the subdivision, because every subdivision is different. So what I'm going to do is I'm going to do a different layout here. So I'm going to switch to the form and I'm going to do it like this. So what you guys see on the screen here and the main screen, and I'm going up and down, is this is MLS. So if I'm a customer and I want to, as an example, I want to purchase somewhere like Katy. So I'll put in Katy right here, Katy, Texas. Okay. And let me go to Katy, and I'm going to look at active listings. Right now, there's 1,400 active listings in Katy. Let me show you guys. So I've narrowed this down only to the city of Katy. You guys can see that right there. But look at all these listings. Way too many listings, okay? Now, what I want to do is, you know, say I'm a customer, I want to purchase here. Okay, this is a subdivision right here. It's called Cinco Ranch. Actually, help people out of there during Hurricane Harvey. This is the whole thing was flooded. We were following Black Hawk helicopters. But anyways, I want to look at Cinco Ranch, and I want to give myself ammunition so that I know that any listings in Cinco Ranch that come active, I can determine whether or not it's a good deal. So the first thing that I have to do, you guys, is I have to price my market. So the way I'm going to do that is all I'm going to do is review sold properties, and I'm going to price my market based on 2022. So I want to look at all of the comps in 2022. So I'm going to put January to December right here, which is all of the sold comps. So to December, and it's going to give me, and I'm going to change this to Katy right here. So I'm only going to look at Katy. So let me put Katy here. So I'm pricing out my market. Actually, do not use Katy. I apologize, guys. We're going to go hyper local. We're going to put Cinco Ranch. Okay. So pricing my market. I apologize. We got to do the subdivision. So I'm going to put in Cinco Ranch right here. That gives me 677 homes that sold in Cinco Ranch in 2022. So let's look at the results right here. Okay. You guys will see on the upper left, there's 677 sold homes in 2022 in Cinco Ranch. And I'm going to select all of these comparables. Okay. And I'm going to hit tabular, and this is going to automatically calculate what the average price per square foot was right here, you guys, in 2022. So me knowing that number, let me zoom in here for you. Me knowing this number, just this one number right here. Okay. Just that one number that gives me the ability to determine if I'm getting a good deal. Okay, so I'm going to use this number to calculate wedge. So just remember $173.46. Okay, so I want to find property under that. So I'm going to go back here. Now that I have that, I'm going to go back to my search. Okay, so I'll go back to our search. I'm going to go active listings right here, and I want to look at listings in Cinco Ranch. Okay, let me show you guys right now. So I have 76 active listings. Let me show you the results. Okay, so now I'm not blinded. I have ammunition. So here's all the active listings in Cinco Ranch. Now, all I'm going to do is categorize and organize these listings by price per square foot. This is very easy to do, you guys. You just have to do it. So now I can tell you guys that roughly, let's see here, there are 18 properties. So 18 properties in Cinco Ranch that are selling for under 2022. So what I want to do is let's do a workup on the very first home. So this very first home right here is technically priced the lowest per square foot. So let's take a look at this listing. Okay. So the first thing I'm doing on this listing, I'm looking at the condition. This actually pretty nice house, pretty nice on the inside. Maybe the floors need a little upgrade, but this is a nice house overall. Okay. So the first thing I'm doing, and look at my form here on the bottom left. Okay. So the market value per square foot is under 2022. The market value is $155.64. So I'm going to write that in my form, $154.64. This is in Cinco Ranch. I'm just going to put the property address is 4311. I'm going to put the purchase price here on this form. The purchase price is $595,000. I'm going to put the size of the property so I can calculate wedge and cash flow. The size of the property is 3,823 square feet. I'm going to scroll down here and look at how much the taxes are so I can calculate an accurate payment. So the taxes yearly, you guys see in Texas, we pay so much in property taxes, but the taxes yearly is $10,102. So you guys see that I'm filling that out pretty nice there. Now I want to do an analysis on this, and I have most of the numbers right now. So this is very, very easy to do, you guys. Now that I have this, all I have to do is pull up a calculator, okay? And I'm going to take the price per square foot that we calculated in 2022, which was $173.46. This is general math. Remember, this is how you get started. Okay, so I'm going to subtract that from the current price per square foot of $155.64. That gives me $17.82. So what I do is I multiply that difference by the size of the house. So 1782 times the size of the house, which was, where's it? 3,823. So 3,823 That gives me wedge of $68,125. Okay. So that's, at least that's wedge, right? So at least we calculated wedge on this property. You can argue that it's, 10% under 2022. So this is 10% roughly for this subdivision under 2022. I found a potential deal, but there's another thing I have to do. Don't forget, you guys, I also want you to calculate cash flow. So we do the same thing when calculating cash flow. We just look at all of the sold property. For rental, I'm just going to go to the last year, 365 days, and I'm going to customize this again to the subdivision, Cinco Ranch. Okay. And let's see, all of the homes that were rented in the last year was actually 443. That's really crazy. Okay, so this is 443 listings that are rented in Cinco Ranch. That's crazy. That's so many. So I'm going to select it all, and I'm going to calculate what the average price per square foot was, which is right here. So the average price per square foot is $1.15. So I take again the size of the house, $3,823 times $1.15 a square foot. That gives me total rent of approximately, my gross rent is going to be, I'm going to put that over here. My gross rent can be $4,396.45. Okay. So now what we have to do is calculate the payment, but let me show you guys where I'm at so far with this form. Okay. So this is what the form looks like. Subdivision on the top here. We're doing a 2022 comp analysis. We've determined that 2022 price per square foot was $155.64. The current market price for rent is $115 a square foot, subject property address, purchase price there, size of the property, taxes. So now we got to calculate estimated payment. Then we can calculate cash flow, but we've already calculated wedge of $68,125. So let's go back here. I'm going to put the purchase price here. I'm going to do a 10% down payment at a 7% interest rate. I've adjusted my property taxes here. I put in homeowner's insurance of $3,500. I'm calculating PMI. Gives me a total payment of $4,968. So when we want to determine whether or not we have any cash flow, we take our mortgage payment. And this is gross. Obviously, you have rental management costs. You have that. So this is a gross calculation. So I take the mortgage payment minus the market rent, which is $4,396, means that I am negative cash flow of $572, which means if I rented this property out, I could not cash flow. So let me show you guys one more time what the entire form looks like now. So now that I have this form filled out, I know that if I make an offer on that house as is, that I can purchase that house with about $68,000 in a wedge, but because of how high the price is, property taxes and insurance, that I will lose $572 a month if I ever rent that property out. So again, that's your subdivision analysis form. That's your basic math on how to calculate wedge, how to calculate cash flow. Probably in the next month or two, you guys, I will be doing more seminars on this and I'll be doing custom market analysis. We'll do more in-depth analysis of how that works. But in a nutshell, that's how that works. It's not too hard. You just got to have access to that data. I know it's a little bit boring, but I hope it was helpful overall. Mitch, sir, any comments on what we just went over?
Yeah, another element to doing that is look at the median household income in that neighborhood, and then start to ask yourself how many of these people, based on the median household income, can afford $4,800 a month in payments, be it mortgage payment and or rent. And you're going to be shocked at the answer. The true value, in other words, is probably going to be around 112, 120, not 155 a foot, because how are you going to get somebody to go into the house and rent it at $4,800 a month? You have to realize 4,800 close to 5,000, 5,000 times 12, that's $60,000 a year in rent.
Yeah. I mean, the median income is absolutely sideways right now. But people don't want to talk about that, Mitch. I mean, we've been literally, just sounding off on how important median household income is, because mom and pop's important, because they account for 70% of GDP, because that's just how things work. So when you understand how things work, you take a step back from the emotion, it's really kind of starts to get clear on how things are working. So we're going to go into our next video. Let me do the timestamp. Our next video is going to be, according to the host of the video, how the market is overplaying potential tariffs. So we're going to listen to that. So the markets are overplaying tariffs and immigration concern. Very interesting stuff here. If you guys can, let me know that the audio is okay, and we'll get started right now for you guys.
Last week, the president demanded they drop rates immediately during his speech out in Davos. Let's check in with our mock feds, see how they feel about that. 6 of our 7 panelists voted for no change this time. Don Peebles once again wants that 50 basis point cut. All roads point back to Chair Powell as investors gear up for what he'll say at the press conference tomorrow. For more on all of this, let's bring in one of our mock fed panelists. I think we said he was the chair this time. I don't know where that comes from, Zervos, but I'm fine with it. If you'd like to accept the honor, welcome.
Might be the nice chair I'm sitting in here, Kelly.
Yeah,
I don't know what that means.
Yeah, it's cathedral.
He is the chair man.
That's right. You're the chairman. That's what you are. You voted for no change. Why?
So I think the market's set up for it. I think they've got no reason to sort of get aggressive right here. They've prepped the market for it. Why would you change it at this point? I am sympathetic to Don's idea that we have, I think, a much lower neutral rate than many in the market or on the committee think is out there, that we're kind of going back to neutral rates at 2019 levels. We've articulated that in a lot of our research related to the balance sheet. But, you know, it's early days. We can wait. Let's get a few more CPI, PCE data prints that feel good, or a little bit of weakness on the payroll side. And I think we can resume again and get moving lower. Which is where I believe we're headed this year. And I think that'll be quite supportive for risk assets.
Get moving lower. That's where we're headed this year. That would be good for, not many people are feeling very confident on that branch right now. Why do you think that is still the way things are going to evolve?
I think the argument that we made 2 years ago, Kelly, that policy wasn't that restrictive because the balance sheet was so large, and that was pressuring stimulus into the system, residual stimulus into the system from all that QE, that's gone. The balance sheet's now at $6.8 trillion. It's getting close to 20% of GDP where it was before COVID. So all that storyline that kept us in the higher for longer camp when everybody else was pushing for massive cuts is reversed. And so we're on the other side of the market. And you know what? I liked being on the other side of the market 2 years ago, and I like being on the other side of the market today. It always feels good to be out of the consensus.
What about tariffs?
I'm just not so worried about them. I'm not worried about the tariffs. I'm not worried about the immigration. I think what the president did with Colombia was an amazing geopolitical strategy, and that's more of what we're going to see with tariffs. Although he does seem to like the idea of raising revenue and more revenue with tariffs. He keeps talking about McKinley, and he had a pretty powerful speech down here in Florida last night, really pushing that almost zero income tax idea. I don't know if we'll go there, but again, I just think the market's overplayed the tariffs hand. The market's overplayed the immigration and the fiscal profligacy risks. And they've underplayed actually what the president said last night, which is deregulation. That's the big story. Kelly, it's the first time I heard him say this, but he said he's polled CEOs consistently about would they rather have tax cuts or would they rather have deregulation? And he says over the years and over all of his discussions in the past administration and then currently in the lead up to this election and the win, they've all told him one thing: less regulation is always preferable to lower tax rates.
We want more regulation, not less regulation. Why would we want to give these bankers and elite more authority to do whatever they want? Mitch, I want to get your opinion on that clip. We're going to go into the mortgage section here in a second, but I want to get your opinion on that clip. To me, when I was listening to him, it was just like, you're an idiot. I can't believe you went to college to learn economics. There's nothing that you're saying that matters or that is important to me as mama pop. I can't use any of the information he's talking to better my life. It sounds like a bunch of children that are just being blown in the wind, Mitch. Am I wrong to think that about that guy? I mean, is there any value we can get from that last comment? Do you think the market's overplaying tariffs?
What you just saw is two talking heads without the benefit of intellect. So the reality is you've got 1.8 trillion in deficit as a direct result of what the fraud was, be it COVID. So the combination is that the dollar, the fraud, hasn't gone anywhere. It showed up in the 1.8 trillion. Well, you're right back to the word fraud. You created a fraud. You, the Federal Reserve, created this. You allowed this to happen, and somebody's got to pay for it. So what they do is they jack the taxes up, both at the local level and through the Federal Reserve in the form of the interest rates, which creates more inflation. So inflation begets inflation. It's the white elephant in the room that these two talking heads without the benefit of intellect, A, know nothing about, B, even if they did know it, couldn't articulate it, C, they don't want to talk about it because it changes the narrative. They're completely useless.
Well said, sir. Well said. Just wanted to respond to this real quick, and we're going to go into the mortgage. I'm going to do the timestamp, actually. Okay, wait. Why wouldn't we want more regulation? Because regulation is a trick. We want free markets to close bad businesses down. Every time we hear, oh, they're going to regulate, they're going to help us, they end up just screwing us and taking away our freedoms. That's why I'm saying we don't want regulation. We just want the government to leave us alone and let things fail. Now, I will argue, though, Mitch, that maybe we should have some regulations when it comes to forced investment in single-family residences in our housing market and institutional investors. But overall, no, regulation's bad. We need the markets to take care of the market. Real quick, let's go into our mortgage update real quick. I'm gonna put that timestamp right here. This will be a very quick update, and then we'll get to some Q&As. So let's start right now, you guys, with mortgage interest rates sitting again, been sideways at about 7%. What you guys see in the upper left is conventional mortgages. Usually people think that conventional mortgages are the best, even though they have a higher interest rate and generally higher mortgage insurance, depending on your down payment and credit, than FHA. Sellers also usually like, when it was bidding wars, conventional over FHA because they assume that someone's better qualified on conventional. It is true that conventional is harder to qualify for overall, but interest rate sitting at 7%, except if you get FHA. A lot of people are doing FHA. FHA is sitting at 6.45%. Make note that FHA has lower interest rates than a 15-year conventional mortgage. So when you're shopping mortgages, if you don't have a 20% down payment and a credit score over 740, you should at least look and weigh your options when it comes to FHA because, again, the interest rate is considerably lower and mortgage insurance generally, depending on down payment and credit, is lower than conventional. The one thing conventional has over FHA is, depending on the loan structure and who you are as a homeowner, the mortgage insurance will eventually go away. Okay, but remember, interest rate higher, mortgage insurance higher, so you're already starting in the reverse. Also, FHA has a lower down payment. Don't forget, you guys, as well, shop your mortgage rate. You're going to want to shop probably 3, 4, 5 different people, see who has the lowest cost and the lowest interest rate. Generally, a broker is going to give you a better deal than a direct lender because a broker generally has lower costs to stay in business, whereas a direct lender has higher costs, and they pass those costs on to you, the consumer, in the form of something called a YSP. I'm sorry, not a YSP. That is global financial crisis. It's now, instead of YSP, it's called SRP, service release premium. So they can charge you a higher interest rate and get more money back. So in other words, shop your mortgage. It's really important that you guys do that. I know it's not fun, but once you've gathered your documents, you should be able to just send the documents off, let them qualify you, see what interest rate you can get. You have a grace period when your credit is ran, but let's see how bad a mortgage really is and how bad refinancing can be. All of these people that expected to refinance after they purchased got swindled. You literally start the death contract, which is the name of a mortgage, all over again. Look at this, guys. It's taking only a $324,000 loan at a 7% rate. Your $324,000 loan turns into $776,000, which means in a lot of cases, from a financial standpoint, it's way better to rent. It just depends on what the deal. There's not a lot of good deals, just FYI right now. But if you guys pay, just to show you how bad this is and how front loaded a mortgage is with interest, if you guys paid only $19,000 down, okay, if you pay $19,000 down, so if you pay this down to $305,000, you guys save 5 years on your mortgage and about $120,000. So you pay $19,000 down, you save those first 5 years of interest. The reason why you save so much money is because all of the interest is paid in the beginning. Look at year number 2. Year number 2, you pay $22,000 in interest. Year number 29, you pay $2,600 in interest. Y'all see how that works? And on top of that, when you do biweekly is so important to do, you guys, because it re-amortizes your payment schedule. Okay, so it's very, very important. Look, if I just put $600 extra per month. Okay, so I pay $600 extra per month to my mortgage. I now turn my 30-year loan into a 16-year, 8-month loan. So the advantage of that is I'm not locked into a higher payment in a 15-year. And also the advantage is I don't have to refinance to turn my loan into a 15-year. All I have to do is pay the principal down. But if you don't do that and you just refinance, you start it all over again. But look at, so not only do you turn that into a 16-year, 8-month loan, you save 200, let's see here. Was this, oh my gosh. You save 224,000. Is that right? Am I looking at this right? No, I'm sorry. It's more than that. It's $227,000. You guys want to save $227,000? Maybe you should listen to what we're saying and pay that thing down sooner rather than later. And again, you guys, a few things about the mortgage. Now, I'll also be teaching this since I have so much experience on mortgages on the front end with primary residences. Just remember, it's about, it's CIA. Okay. So in order to CYA, to cover your butt, you have to CIA. Okay. Credit, income, and assets. So that will be one of the seminars I'll be teaching on top of subdivision analysis. When it comes to your credit, remember one of the biggest impacts you can have, an immediate impact on your credit, is something called utilization ratio. Your utilization ratio only applies to credit card, not car loans, not mortgages, not school loans, only credit cards. And that means how much is your credit line compared to how much you've maxed it out. You don't want to go over 30%. You do not want to go over 30% of your credit line on your credit cards. Remember that. So credit, you want minimum score FHA is about 580, depending on compensating factors, but you don't really want to buy a house unless your score, it's hard for me to say this because my house I purchased after I had my bankruptcy and stuff, my credit score is 630. And I ended up making a lot of money on that sale. So it really depends on your situation. But if you want the best interest rate, you want a 740 credit score. So if you get your credit score to 740, you're doing good. As far as income, remember, if you're on a W-2, you need 2-year history. If you're self-employed, part-time, or you want to use 2 jobs, you have to have a 2-year history in order to use that income to qualify. And now as far as assets, so credit income assets, remember 5-10% down, FHA 3.5% down, home ready or home possible is 3% down. That's conventional. It's a really good program for first-time home buyers. But remember, when it comes to your assets, you want to have money left over after you close. So don't go broke buying a house. You want money after you close. And remember, it's a legal requirement for a loan officer to review where your money is coming from to purchase a house. It's called seasoning. I am legally required by the Patriot Act disclosure to review all of your money. And I hate it. I have to review months and months of bank statements. So whatever, remember this, whatever money you're using to purchase a house, it has to be seasoned. We cannot use cash, and it's seasoned for 2 months. After 2 months, we don't look. Okay. So we look at the last 2 months of your deposits into your bank account. If the underwriter doesn't like anything, they will cancel that out, and you are not allowed to use that to buy a house. So just listen to what I'm saying. I have a free course already. I'll be teaching you guys a lot more of that to make you guys strong buyers. But that in a nutshell is the mortgage market. It's absolutely a dumpster fire right now, and only the strong are surviving, and you guys got to shop your mortgage. Mitch Vexler, anything you want to add to that, sir?
Well, I assume you want to end the video or get pretty close. So with regard to the videos that we did, the school district fraud and the Ponzi scheme, if you have access to those type of people who could further push these videos out, that would be wonderful, because we're just 2 people doing the best we can to roll this stuff and create this information. So anything you can do to help push those videos, it's important, and I appreciate it.
Yeah, and we do. You guys, if you guys saw my to-do list on what I'm supposed to do today, it's so overwhelming. We're trying to create a school at the same time. We're working on a lawsuit right now because of all the slander that's going on in Tennessee and West North Carolina against a municipality. So that's just on the to-do list today. I hate talking to attorneys. It is what it is. Let's go into our last video, which is consumer cinnamon or sentiment, whatever you guys prefer, not like sediment, like at the bottom of a river, sentiment. So let's look at that video, see how the consumers are feeling. But I don't even have to watch this video. I could tell you how we're feeling. We're sick and tired of this crap. We're overwhelmed. We can't even barely save our money. And we're like married to our dinner because food costs so much money. So if you guys can, let me know that this video, the audio is good. And I hope you guys enjoy. Let me do our timestamp right here for this video so you guys can come back and take a look at this and let me know the audio is okay.
Some consumer confidence data out a few moments ago. Rick Santelli's got it. Morning, Rick.
Good morning, Carl. Indeed, these are January conference numbers from the Conference Board. on the headline number, expecting very close to 106, a bit of a miss here, 104.1. And in the rearview mirror, though, there is a big positive revision. 104.7 jumps up to 109.5. 109.5 last month would end up being the best since July of 23. So the revision is big. It really is solid. Now, if we look at present situation, 134.3. 134.3 is a miss, weakest since SEP of 24. Obviously, it's sequentially lower, 134.3 following 140.2. What lies ahead are expectations, 83.9. Believe it or not, this is actually the best since Nova of last year, so not that big of a comp. 83.9 doesn't sound so strong, but it is following 81.1. If you really want to look at a solid number, we're competent to Nova, but Nova's all the way up at 93.7. And finally, if we look towards the Richmond Fed, we have manufacturing and service sector. On the manufacturing side, minus 0.4. Minus 0.4, that's actually better than we were expecting. We were expecting a number in minus double digits, minus 10, minus 11. And if we consider this is now the 15th consecutive negative number in a row, but it's still the best since May of last year at minus 4. And finally, on the service side, positive 7 is our read. Positive 7 would comp, of course, to last month's 14. It ends up being the weakest positive number going back to October when it was negative at minus 4. We see that interest rates haven't moved much on that data. 455 is up 1 on a 10. 420 is unchanged on a 2. 7-year, 44 billion of them will be auctioned off at 1 o'clock Eastern. Carl, back.
I am looking forward to not listening to these people anymore. This is an interesting comment. I respect it, actually. Cool beard, by the way. Travis, why do you only use fake news outlets? Because there's no honest ones, brother. Tell me the honest news outlets. I'll start using them. Oh, you know what? Zero Hedge, but they don't have a lot of videos. I do like Zero Hedge. He's not wrong. These people are all dishonest and freaking crazy, man. It is what it is. Let's do some Q&A now.
There's one comment, though. So he was just talking about the Richmond Fed. That's the manufacturing survey. If you listen closely, he literally just said 15 months negative. It's exactly what we've been saying. How can you have 15 months of negative industrial production and think that we're not in a recession?
Because Jerome said something different and people still trust the government. They're overwhelmed. All right, let's do some questions. You guys throw your questions up. But still, I mean, they're a bunch of liars. Okay, we answered this one. Let's see here. This is interesting. We won't see a real correction without higher rate hikes. But remember, we see prices go down in recession during rate decreases. Remember, I showed you that during the beginning of this video. Go back to the video. You'll see that they decrease interest rates into recession. The Fed needs to rip off the Band-Aid. I 100% agree. It's only prolonging a market crash, which prolongs any reset in housing affordability. Mitch, do you want to comment on that, about how if we would have just had a recession maybe in 2022 when we were already having a period of deflation, maybe things wouldn't be so bad? Do you think that all this inflation and propping up is going to make a recession worse?
Yes, because somebody is going to have to pay for the debts that have been created. So what they're doing, you can inflate your way out of this, but that also has a cost, right? That's what happened in the Great Depression. They tried to inflate their way out of it and poof, it broke. So the reality is the Federal Reserve is the purveyor of fraud, as are the central appraisal districts, and they have to go. It's the only way to get the market to do what it can do without putting the increased cost of the inflation through a tax onto the backs of mom and pop. They do not have the money to pay, period. So all that the delaying the inevitable is doing is costing more money. That's it.
Here's another comment, Mitch. I don't even know if I should throw their comment up because they're more worried about me shaving than the actual comment. They're like, Travis, why don't you shave? Like brother, like I do shave. I don't know what you mean. I shave all the time. I freaking hate shaving, by the way. I almost went into the fact I also hate having pimples, and I'm in my 40s. I know I probably eat too much candy. Don't lecture me, Mitch. Here's a good one from TW. No one listen niobim is equal to or better than silver. Do you want to talk about that? Is that a good investment? And can you pronounce that?
Probably not, because it's not in the realm of gold, silver, platinum, where you can trade it off quickly. So that's the one advantage, right? Because those elements, those precious metals, are currency. At the tail end of the day, they're currency. So, it just is what it is, right? You want, if you want to make an investment, you want to at some point be able to get out. All we're saying is there's a high probability that the precious metals have a long way to run.
Okay. I mean, I may buy some silver. This is a good question right here.
Well, scale in.
Okay.
Don't do anything stupid. Just scale in. When you get a pullback in the market, you buy a little more, and you buy a little more, and another pullback. It's just.
I'm looking forward to our seminars. Good question right here. And when I was a loan officer, this used to give me so much anxiety when people would ask this question. It's a common question. But Travis, I'm trying to buy a car right now. Do you have any surface level advice? First thing I'd like to say, Chris, is remember, generally buying a vehicle is a depreciating asset, and purchasing a vehicle, if there's a loan, it's going to negatively impact your debt to income ratio. If the higher your debt to income ratio, the less of a house you can get qualified for. So understand, Chris, if you purchase a car right now, you're buying a depreciating asset in a time where we're probably going to be cash is king. So if you're going to get a vehicle, get a used vehicle and shop that son of a gun to death. Try to pay the whole thing off. Don't get something fancy or new, and understand it's going to negatively impact your ability to purchase a home because, again, of your debt to income ratio. Debt to income ratio is calculated by looking at your monthly payments. Your back end, your front end is just mortgage. So understand that. Okay. I don't know, man. I don't think you should do it. It's very emotional, but if you're going to do it right, get a great deal. Understand depreciation. Maybe buy it under Schedule C. But I'm not giving you financial advice. Schedule C, so you can claim the depreciation. So that's that one. Let me throw up another one right here. Okay, Mitch.
This one's go and shop. If he's interested in a new car, the lots are full and the discounts are massive. I know of a car sitting in a used lot. It's a new car dealership, but it's a new car with a $20,000 discount on it. I'm a believer, obviously, in used cars. Because of that depreciation. But the point being that the car lots are full. So name your price.
Good luck out there. So here's another good one, Mitch. This is about property taxes. How can it be legal if someone's paying $123 a month in property taxes, and when you buy the house, it goes from $123 to $375 a month? I'm going to say right now, I've actually seen a lot worse than that. I've seen it go like double. That actually is a double, but like go from like $400 to $800. One reason is new home. If you buy a new home, generally the first year of ownership of that new home, your property taxes are way too low because the county still has the home valued at the dirt, not the dwelling. So you're going to always want to be careful when buying new construction because that will blindside you and it will absolutely bankrupt people and cause them to go into foreclosure. That has been happening all the time in Texas with new builds. Another reason is removing a homestead. Like if a current owner has a residential homestead, say a disability homestead or 65 or plus homestead, when they sell the house, they remove the homestead protection and then the true tax liability is passed on to you. So there's multiple reasons why, but they bring up a good point. Make sure if you're purchasing a home, look if the current owner has a homestead, because if your loan officer is calculating a mortgage payment based on the current owner's homestead, they're not calculating it correctly and you can get into trouble. Anything you want to add there?
Yes, the key word is legal, and the answer is it's not under any circumstance, including the 16th Amendment to the U.S. Constitution. So when you cut down to the chase, none of this is legal. And that's the point that we're making in these videos.
They said they had to get a vehicle. Well, get a Honda Civic, man. Please get a Honda Civic. Please get a Honda Civic. Okay, here we go. From my man, P Nice. I love you, man. Thank you for all of your support. I really appreciate you guys like commenting. I mean, it means so much to me, you guys. I've been so just distracted from various layers of work. I mean, we are going out there, man, and we are fighting. I got a lot to tell you guys. I can't wait. So this is from P Nice. All that to say, I love you, P Nice. Does Mitch see any market crash or deflationary situation? And if so, would it come with that? Would it be global, even with decoupling? You want to answer that, Mitch?
If you bifurcate the elements of the market, so if you look at coincidentally, the auto industry, right now, you're in deflation. We've got entities that are offering $20,000 discounts on cars. They're not moving them. They're deflating. So that is a huge problem. When the bubble busts, you will end up with deflation. The problem is right now, and you're starting to see it, when people go to a grocery store, $7 a loaf of bread, they're just saying, that's it, I pass. So then production drops on those loaves of bread because people aren't able to buy. It's the same thing with the autos. So the system is broken. The question of an out and out crash is just how long can they keep the fraud going? We're working to eliminate the fraud to put a stop to this nonsense. So there will have to be a reset. And as I said, this is not going to be pretty. This is going to hurt. But at the tail end of the day, it's necessary in order for mom and pop to survive. You've got 30% plus of your households right now today that are dancing on bankruptcy's doorstep and or will lose the roof over their head. And the only thing separating them from bankruptcy is $9,000. And of that $9,000, $7,000 is real estate tax. And I've had multiple conversations with some very interesting people just within the last 4 days about that one issue. And it's huge. So President Trump is looking at saving money on the federal side. That's missing the point. And Elon Musk is missing the point. The real way to fix this problem is eliminate the real estate tax, because instead of you writing a check for $7,000 in taxes, that money is now in your pocket. Well, think of all that money across the United States and across Canada that would be floating in the economy because you had that in your pocket. What could you do with that money? What business could be started with that money versus paying that money for the sole purpose of keeping the fraud going? That money doesn't enter into the economy. It enters into the fraud. So this is going to hurt.
Well, if you're hedged right, it will hurt less and maybe you can make some money. I've been trying to hedge, but man, it's been brutal, Mitch. All right. Here's a comment right here. Mitch, I appreciate your time. By the way, I know we got to go look into all this lawsuit crap. And I'm going to get to the seminars. I'll get to the teachable here. Good question right here. This person is in the process of purchasing a house in the Dallas area. They're saying that prices are slowly coming down, but interest rates are still high. They're asking if it's a bad time to buy. Now, here's the thing. I'm going to make an assumption, and I'm going to say for you it is. And the reason I would say that, because I'm making an assumption. I don't know you, right? I don't know what your goals are. I don't know your credit, income, or assets. But I would say it's probably not the time to buy for you because you didn't lead with wedge and cash flow. You didn't lead with a good deal. You're just saying that price is coming down, but interest is so high. What does that mean, brother? Does that mean you can afford a house? Does that mean it has wedge? And here's how I want to help answer you. Go to the beginning of this video and watch how I did that market analysis, and I calculated wedge and I calculated cash flow. And remember what I said, be careful about your property taxes, especially if you're buying a new home, which you might be looking at new homes because Dallas has plenty of them. And again, you guys, I am going to be doing seminars. So, if you guys are in the process of buying and you join my seminars, we'll be able to talk about this in more detail. Mitch, I want to give it to you, but first, let me show, excuse me, and remind you guys. So this is all free for right now. You guys can come to my Teachable account, the Real Estate Mindset Empowerment Center. Here's all the free stuff. You got 2 free courses on how to fight property taxes and how to buy a house. You have you have Mitch's amicus brief and the bill to eliminate property taxes. Right here, you have the property tax fraud from the Department of Education. Here's the subdivision analysis form. That's what we filled out in this video. Here's your tax protest form. So my class will be seminars on this form and seminars on that form. Mitch will also be doing stuff. But again, you guys come here, put your email address in there. Man, I'm really looking forward to doing seminars and teaching, and I can't wait to do that. It takes a lot of work to do that. Let's see if we have any more questions here. Excuse me.
Yeah, I want to point out that
the
reason Travis is building this teachable section, there's several thousand every time one of these videos gets produced. There's several thousand comments, and the amount of emails that I'm getting, I do respond to all the emails. If somebody leaves a phone number, I can't respond on the telephone. So if they respond by email, I can handle that. But if they respond by telephone, so the thought was, okay, let's try and focus and be able to answer everybody kind of on a bulk basis with regard to the questions, because we do see them. I don't respond to everything on the videos below, but and Travis can't, because we're just two guys and we get several thousand comments per video. It'd be impossible, but we do see them. Jeff Mashburn, who has been in the background working on the HVAC fraud contracts at the school districts, he sees them. So if stuff comes up that's important, we deal with it. So with all that said, the idea of the Teachable is to help us be able to communicate better through the circumstances that you're finding these problems with in your life. So that's really what he's doing. I'll do the odd newsletter here and there, and I'll contribute a little bit. But the guts of this, like with Melody there, and with Jeff there, and with Travis there, that's going to be, by the time it's up on its feet, it's going to be really good.
Yeah, I'm hoping excuse me, getting so choked up because it's Friday. I guess I'm just so excited, but we're trying to give you guys something that you've never seen before. Literally a community and a network of very smart people, very good people that you know, all in one area, designed to teach what they specialize in. So, man, I'm so excited about that. Well said, Mitch. Some funny comments here. You guys have any other questions? I don't see really any other questions here. Mitch, I definitely appreciate you. To the viewers, let me see, I think I have one more here. So I'll end with this one. Mitch, maybe you can comment on this and then we'll just wrap this up. We're at an hour and 40. Banks will credit freeze loans, cash king for housing. So like global financial crisis, the banks, and this is why I say we need to let banks go out of business. If they start going out of business, they will tighten credit up and they will slow things down and cause things to crash. Mitch, do you want to comment on that comment? Comment on the comment?
Yeah, it actually ties into the precious metals idea. So again, precious metals are currency. Precious metals are savings. It's in your pocket. If you had, just for the sake of conversation, don't anybody go do something crazy, but if you had $250,000 in precious metals, do you know that you could walk into a bank and say, I've got $250,000 in precious metals, and you can use that for a loan to buy something and you still hold the precious metals? It's the same as cash. So the thing with where you say cash is king, yeah. Do you want it as cash, as in dollars? You want it in precious metals, and your precious metals are going up and the value of your dollars are going down. So the point is, when a crash occurs, and it is happening, it's slow motion because things, be it the fraud, are holding it up. So a crash will occur. It started in the automobile business. It's already there. It's happening live. You're starting to see little bits of it in the housing market. As the inventories go up, the prices will come down. But there's no margin of safety just because the prices come down due to the natural gyration of the market. The trick is to create a margin of safety and pick something up that's $30 or $40 below the market at that time. Now you've got a margin of safety. And as I've said, be real cautious about buying a new home. There's a big difference in the quality of a 20-year-old home versus what you're getting in today's world.
Yeah, well said, sir. Well said. Absolutely. And again, don't use your emotions to buy a house. We'll end there, you guys. Really looking forward to helping to create a stronger community. Once again, happy Friday. Don't go out. Don't go to the bar. Please save your money. Instead of going to the bar, maybe getting some shots of alcohol, go buy some silver. I'm not giving you financial advice. I'm just saying maybe just this weekend, okay, you don't go out to eat. You don't go get drink. You go to the store where they're selling silver.
If you want to try and buy a little silver, you can buy it, believe it or not, at Costco. There's all sorts of good brokers out there.
Costco?
Yeah, you can buy gold and silver at Costco. The markups are reasonable. You can buy it through the SD Bullion. I'm not promoting anybody, but there's very good, legitimate sources that are out there. Peter Schiff's got a gold company. The markups are a little high, but you get quality there. So the point is, believe it or not, if you want to buy just a little bit, you can go get it at Costco.
Yeah, no vodka, no tequila, silver and gold. Think about it. Maybe you should, maybe you should. I don't know. Mitch, I appreciate you. We will get to work today. We will start fighting. We'll start trying to make change. Again, you guys, we cannot do this without you. We're just two people. We need your help. We need you guys to follow along. Don't forget, hit the links in the description to sign the petition. Go to the school, start learning stuff. Stay tuned for some updates. We're really excited to give you some. And happy Friday. If you guys, Yeah. go
Yeah,
ahead,
and
what were you
those
saying?
2 videos, please.
Oh, yes. And the 2 videos, push those 2 videos on the property tax, please. We're going to do a 3rd one this weekend. And if you guys are out there investing in real estate or just living your life, you guys already know, we wish you luck and we hope you win.